All right, so now that we have an idea of the different cost flow methods, I want us to apply it to this table here. And so the table is just a purchase and sell log for a company over a month's time. So during this period, they had three purchases, one at January 8th, one at January 25th, one at January 29th. They had beginning inventory and they had two sales, one at January 10th and one at January 30th. In the table, we have, of course, the dates and the transaction that we're considering, whether it's beginning inventory, a purchase or sale. We have the units at their purchase price. And so these are all gross price. These are full price before any discounts have been applied. The units that were returned from the sale, any discount recognized, and then considering the factors that we have here, the number of units we purchased at the full price, the number we returned in a discount, and also freight, we can come up with a price per unit. And we'll talk about that in just a second, how to calculate these per unit prices. So basically, I tell you that on January 31st, there were 460 units on hand. That is our physical count of units. Remember, of course, we always need to make sure we need to check whether all units were sold. And this would be for our shrinkage consideration. So anytime I tell you about the number of units on hand still, understand that that's a physical inventory count. And what that can be useful in determining is under the perpetual method, how much shrinkage I need to record. But remember, that's perpetual method only that we can record shrinkage. And we'll see why. Remember that the periodic just takes that number of units and assumes that anything that's missing from this 460 had to have been sold. So this whole check is only for the perpetual method. Associated with all the purchases is a freight fee, a freight in fee. So the business is bringing those units in, has to pay 50 cents per unit on all units. I just keep it even to keep the calculation consistent. And so we're going to need that in determining not just the price per unit, but also the amount that should be in our inventory account, because we do count cost of freight bringing it to my place of business into the total price of inventory. And when we return units, assume freight is reimbursed. So that means that we're going to have to credit the freight in account for any reimbursed units. And that returns are made prior to cash payment. So what that means is returned units don't get a discount. Because we only get that discount, remember, when we make the cash payment. So this is textualized for you down here. Discounts can only be received on units that are kept. Returns are still full price, right? Because we didn't pay for them, so we don't get the discount. Freight only affects the units that are kept because freight is reimbursed with returned units. So in my calculations, when I'm calculating freight, I'm always going to be calculating freight based on the units that I actually kept. So not 1100, but 1030 after I subtract off the units that I returned. And I'm just going to be, for this example anyway, using the gross method when recording these items. So the first thing I want to talk about is how to get this price per unit, because this is all we really need when recording under the perpetual method, cost of goods sold and inventory. Right? So how did I get 834? Well, I start at the full price of $8 per unit. And obviously I don't have enough room up here, so make sure that you're noting this appropriately and making a reference on another piece of paper. But yeah, it starts off at a gross price of $8 per unit. Now the discount is 2%. So to get a net of discount price, I'm going to multiply it by 98%. This removes the discount and just gives me that net of discount price. And the net of discount price for these guys, $8 times 0.98 is $7.84. And of course, you could take 2%, multiply by 8, get 16 cents, subtract 16 cents from 8 and get the same amount. But this just gives me a one-step product that gives me the same result. So right now it's 784. And we're not quite at 834 yet, but remember, there is a 50-cent fee per unit of freight. So I'll add 50 cents to that. And really, with freight, then this price goes up to 834. So that is how I got these price per units here. If we wanted to get a calculation of then the total dollar value of inventory that was purchased here under this one purchase, we would take this amount and multiply it by the number of units kept. Oops, I forgot to identify the freight here, just so you know what you're multiplying. Net of discount percent is the 98. This that I'm about to multiply is the number of units kept. And in this case, we had 1,100 that we bought, 70 were returned, and so 1,030 units were actually kept in this inventory. And we can take the 834, multiply it by 1,030, and that gives me $8,590.20. So this would have been the total increase to my inventory account under the perpetual method. Gross price, net of discount percent gives me the net of discount price. Add in the freight per unit gives me the total price per unit. To figure out then how much inventory was affected by this purchase, we only consider the units we kept. Okay. I would take a moment and apply that to my other price points here and here. Make sure, pause the video, make sure that you're able to calculate it, that you understand what you're calculating at every step, and come up with the total amount, at least the price per unit, and then acknowledge that you could take, for example, the 923 and multiply it, in this case, by 330 units because I bought 350 and I returned 20. All right, so do that on your own. Hopefully you did it. Let's talk now just a little bit about why this is an increase to inventory. I'm going to prove it to you. If you don't need the proof, if you're not doubting me, then you can kind of fast forward through this part. But if we're using a perpetual method, I'm just going to lay out some journal entries. The journal entry to record the purchase. Remember, we're using a gross method for these items. So when I bought that inventory, it would have been debit inventory, credit, accounts payable for 8,800. When I returned units, I would have debited my accounts payable, credited inventory, by 70 return units times 80, I'm sorry, $8. So this is the journal entry I would make for the return. When I bought those, I forgot to throw in the freight. 50 cents freight on 1,100 units. I would debit inventory because remember, freight increases my inventory account. Debit inventory by 550. And then we pay freight in cash because typically we pay a third party for freight. It's not going to be a part of the discount that the manufacturer of the inventory is giving us. Now we made this return. Well, we get reimbursed that freight. And so we're going to get reimbursed the cash for the 70 units that I returned. And at 50 cents per, that's $35. And my inventory goes down 35. So we got a purchase with freight just to make sure we remember exactly what these two entries are for. The first one is the purchase. The second one considers the amount of freight. And now we have a return with freight reimbursed. And then finally, the only thing that's left to record would be the payment of the inventory. And if we assume, and I always do in these cases, that they took the discount on everything, then we have an AP account that we have to get rid of. My accounts payable account started at 8,800 for this transaction, right? There could be a lot of accounts payable in here. There probably is, but I'm just focusing on what this particular obligation to our manufacturer was. We debited it by $560 and we come up with $8,240. So that's the amount of the payable I need to pay off. Remember, because we're using the gross method, this is full price, full dollar value, so it doesn't have a discount at all. If they took a discount, then they don't have to pay me the full price. They're going to pay that 8,240, except that they get the 2% discount. So they actually end up paying me $8,075 and 20 cents. And again, I just figured that out by taking the full price payable that's recorded at its full price and multiplying it by the after discount amount because they don't have to pay 8,240. They get 2% off that price. And then finally, we need something here in order to balance the debit and the credit. And that is going to be a purchase discount. But because we're using the perpetual method, that would just be a credit to the inventory account for $164.80. And if you check the math here, it adds back up to the liability amount of 8,240. This is for the payment of the payable. Okay. So make sure that this is locked down. This was the first part of chapter 8. Now, just to verify, as I was going to do, that this leads to an $8,590.20 movement to inventory. Again, we're just considering the inventory transactions that happened here with the purchase of freight, the return with the freight reimbursed, and then paying the ultimate payable off for the units we kept. So that is at 8,800. We add 550 with the freight here. We credit it by 560 when we make the return. That's just for the price of the units we returned. We credit by 35 because now that freight associated with the returned units is being reimbursed. And then we credit for the discount as well. So go ahead and reconcile that. And when we reconcile that, if you went through the motions yourself, I hope you did. It helps. It helps your memory to work through these things as well. We get the amount that we predicted it would by just doing the calculations, right? It makes sense. We took the discount off when we determined the price per unit here. Well, that was basically the same as crediting inventory for the units we kept. We added 50 cents of freight for every unit. That we kept. That was captured by the debit and the credit here for the amount of freight added to our inventory and then reimbursed for the returned units. And then we kind of indirectly credited inventory when we just looked for the number of units we kept because we didn't consider the full 1100. It helps. I know it seems like work that isn't helping you. It helps to lay these out. It helps to work it both ways. This is how you really master information and understand what it's telling you. Right. So that is the story behind these amounts, how I get the price per unit, how we can use the price per unit to determine, oh, this is basically inventory going up because of a purchase, right? That's how we can conceptualize what's going on in this table. And I'm going to roll forward now and talk about all of the perpetual methods calculation of cost of goods sold.